So happy to have you here, Stuart. I found you and found it interesting. You were a CFA and you're running a virtual family office, and we do some similar things. So I figured it'd be fun to have you here on a chat on the Unconventional Money Moves podcast. So happy to have you here.
Oh, thanks for having me, Josh. It's been great. So, yeah, let's get rolling.
Yeah, I was doing some digging. Did you start something called Y Charts? Were you like, what was your involvement with that? I'm getting phone calls from them all the time telling me to buy their product.
Yeah, so I did not start them, but I was a founding shareholder. So the owner, the founder, his name is Sean Carpenter, and he and I had a personal relationship. And this is back during the post.com bust, right? He had built a website called wallstreetview.com, and he was getting a ton of traffic to this website. And then people, just because it had a .com on the end of the name, there were some companies coming to offer him $50 million to sell this website, even though it wasn't profitable, wasn't making any money, wasn't even trying to make money. And he's like, this is not worth $50 million at all. And ultimately, it was on the decline. So he ended up not ever selling anything. But then after a little while, he realized that nothing had been updated. When people were going to Yahoo Finance, you could see a price chart, but nothing else. You could see a PE, a stagnant PE, and that's about it. And then Yahoo Finance hadn't really updated anything for 10 years. So he said, wouldn't it be better to look at the charts of growth rates, the charts of revenue, the charts of PE ratios, the charts of, um, like consumer goods sales or oil prices over time versus just the price chart? And so when he was pitching this idea, I said, yeah, this is great. And then as he was going out to raise money, they said, well, we need a way to rank and rate stocks. And that is something that I had already built for myself and my firm.
Mhm.
So I wanted to, I have a deep math background. So I wanted to be able to rank and rate stocks based off of fundamental characteristics of company. So what characteristics tend to lead towards outperformance over time? Buying low PE stocks actually tends to work over time. Buying lower than higher PEs, a Warren Buffett strategy. It's not a surprise. So Sean came to me and said, look, we need a way to automate this. And so I helped him build that part of the structure of white charts. And from there, he was instrumental and grew it out. And I just had that one little area, but I was a founding shareholder.
And did I see you in school for engineering?
Yeah, I have a chemical engineering degree from Northwestern. So I
Cool.
worked as a chemie for a couple of years at Goodyear, down in Pasadena and then in Akron, Ohio for a little while. So super fun working as an engineer, building, like making rubber that went into tires and rubber that went into a bunch of stuff. Very stinky work.
Yeah, I went to school for actuarial science and just ended up in finance somehow, even though it was never advertised to us that like, hey, like you actually have all these skills that can translate over the finance. And the same thing with engineering, because with engineering you have to have the mathematical background, you're essentially a problem solver. And that's the problem about being an engineer is sometimes you can get a little bit pessimistic because you're trained to find problems and solve problems all the time, which is going to make you a great engineer and could make you a great investor. But in everyday life, sometimes you can make things a little bit dark.
Yeah, dark and sometimes not the most popular conversationalist in cocktail parties.
Totally. So how did you transition from engineering to finance? What was that like?
It was surprising to me, to be honest with you. As an engineer working at Goodyear and at corporate headquarters, I had a buddy of mine that said he was going to go get his MBA, and I can remember him going over to his apartment, having CNBC on in the background, thinking this is the most boring thing I can think of. Like, why would you possibly even want to get your MBA? And about a year later, I know somewhere along the lines, I decided that this is something I wanted to get into and got into Kellogg and got my MBA and um, ended up I ended up working for a company that was basically trying to take a bunch of golf courses public. So they're building a REIT and buying golf courses, buying the debt of the golf courses specifically. And then we were going to take that public. And just in any business, you either want it to be amazingly successful or flame out really fast. And this was in the middle, which is like the worst. So we crept into the public markets, barely made it. Kind of languished around. It just wasn't like a big success or a big failure. This was in 1997, right as the dot-com boom was happening. So people were buying all these dot-com stocks that were doubling overnight practically. And who wanted a REIT that paid 6 or 7%? Nobody. Like that just wasn't on the radar. So had we built this in maybe 2001, 2002, could have been a whole different story. But so that's when I think Warren Buffett sold an idea in his wallet for $250,000 on that little idea. It said REITs. So we did this in 1997. And as they say, timing is everything. So it ultimately imploded on itself. So I was looking for what I was going to do. And I sat in the life or had a day in the life of a derivatives trader, a bond sales guy, equities sales, institutional desk, and then private client services. And that's kind of the path I went down. I thought that was going to be much more well-rounded and got into wealth management back in the late 90s.
Yeah, I remember I was listening to like a Jeff Bezos interview, and he's like, I had to tell people what we were doing, and it was so cool, and the internet was growing at a exponential rate, and people were starting to get on the internet. And then the investors would be like, what's the internet?
Right.
He literally had to explain what the internet was, which fast forward to 2024 would be like a crazy question. It's like you're out with someone having a coffee and they're like, what's the internet? And you're like, what do you mean? Everyone knows what the internet is. And ultimately people don't even know how Amazon, I think, went down like 90% at one point.
Yeah.
And everyone was saying Warren Buffett's lost it. He doesn't know what he's doing. And what people don't realize is, and right now we've been seeing that with NVIDIA, it's like, yeah, it's exciting. It's fun if you bought it at the right time. However, over the course of time, slow and steady ends up winning the investment race, just the boring investment strategy, getting down to the basics. And
that's right.
Were you in the business during that time? You were just entering the business? What was that adventure like?
I got my desk and my timing has been really off. I got my desk in 1999, like November of 99. I passed my Series 7. Well, what happened is I sat in the life of each trader, and I got a job offer with Lehmann Brothers in New York. And they had a full-on training program. I don't know, there was 50 or 100 of us going through. They're like, in the next year, 80 of you are going to be gone. In the next 10 years, 95 of you will be gone. Like that's the kind of turnover in this business. And we had an exam, passed the Series 7, and then, so this is like November. They moved me to Chicago, November of 99, and the stock market peaked March of 2000, right? So I had 4 months of fun and 3 subsequent years of terror, right? Or what some of the old timers were like is, I know you're going through hell right now, but it will get better. So I tried to build my book of business through 3 years of .com post crash, which wasn't great, wasn't easy. And then I left Lehman Brothers after about a year and went to work at Bear Stearns in the late 2000s and was there till 2007 when I went to start my own firm in 2007, right before the financial crash. So I left a huge book of business back at Bear Stearns. I brought 20 clients with me, just the 20 that were in my quantitative strategy. Actually asked 20, 19 came with me. So very meager beginning. And then the financial crisis hit and lost 30, 40% of my book of business just went down the sewer just because the valuations all fell. So tried to build my book of business in one of the worst environments again as I moved. So that's kind of what's been my journey. And of course, we've seen COVID and a couple other meltdowns along the way, but yeah.
What does a trading floor look like when you're working at these companies in the early 2000s compared to like what people think it looks like?
Oh, in the early 2000s, it was a mayhem, right? You know, they're just like yelling and screaming and just paper everywhere. And just if you go on the Trading Places with Eddie Murphy, one of that old movie, it was a madhouse. And now, and this is even years ago, I went and shot some videos for a firm that was like daily stock tips or something. And you can hear a pin drop in there. It's like cleared out. A lot of my friends, they they were, S&P traders and whatnot. And they just, at some point, they said, we just cannot keep up with the risk. The algorithms are just taking over and we just have to take on too much risk to make the money. And at some point we're going to get run over. So they just had to step out. They couldn't be on the floor, just wasn't profitable enough for them from a risk reward standpoint.
The algorithms are interesting now. And I believe we've been seeing some algorithmic trading so far in 2024. And you could see it happen. You can almost see it happen when you study the markets. It's like, oh, it goes down sharply and the VIX spikes at a stupid rate. You're like, this is just like a short circuit.
Yeah.
And a lot of people are doing automated trading now, and the robo advisors, I think they tried to, I don't know if they're still around, but people are trying to use the robo advisors. What are your thoughts on these sort of things?
Yeah. So, I mean, I'm a big math guy. So my whole pitch in the beginning was we use math to buy stocks better than just some random guy on the street that's going to be a financial advisor. And I still think that's better. If, again, as a student of behavioral finance, when you look at the data, not being emotionally involved tends to be better than being emotionally involved when it comes to trading. And those are just facts. So having an advisor that is not emotionally involved with your money is probably also going to be superior than you trading who is emotionally involved with your money. But having a robo trader is probably going to be better on some levels. Now, I say that's what YCharts was built upon, was using data to make better, smarter investment choices. I gave a TED talk on using data to make better life choices. So I'm all in that world of, do we use data and how is it used? Now, as you know, garbage in equals garbage out. So if you're not programming well, or your data is bad, or your goals are different than what somebody might be hiring you for, you're going to get unexpected results. So the robo advisors are good. In my opinion, they're really good for just a very, very core basic way to build a portfolio, and they help with tax efficiency, and you're probably going to do fine. When you actually look at the results and how does AI work so far with some of the trading, and how does some of the it's spotty. It is spotty. It's better than usually an individual doing it themselves emotionally, but it is spotty getting those results of outperformance.
I just stumbled across like an ad the other day on social media, and this person came out with a portfolio copy strategy where you can copy other people's strategy and invest, like it has like a Bill Ackman copy strategy.
Yeah.
And I was thinking about it, and it's like, it's advertising, we buy and sell as they do. And I was like, well, they buy it and then they have to file, and then there's some sort of delay there on like when they file a 13F. So like you could be copying it. However, with the amounts of money these trading firms are dealing with, when they buy something, typically the price goes up just because the amount of money they're putting into something. And then I thought about it on the flip side. I was like, well, if you're buying and selling and just copying, that could affect you from a tax point of view. So what's a good mix for someone to use using data and AI, which is a super valuable tool? At the same time, though, having that human touch and having that foundation, such as having that engineering background, when something goes wrong, such as the AI is not working correctly, you have to have that background and you have to have that foundation in order to navigate uncertain waters, such as in 2022, interest rates went up at the fastest rate, and people in that 60-40 portfolio did really bad.
They got crushed. Yeah.
They got crushed worse than if you were 100% equities, pretty much.
Every major asset class was down in 2022, right? So stocks were down 19.5%. The Qs were down 36.5%, international 17.5%, bonds were down 15.9%. So crypto was down 80+%. If there was no place to hide cash, commodities were up. Commodities were positive during that time. Real estate was also down big. So they're saying correlations go to 1 at that point, and they were pretty much going to 1, and risk was way up. So it's a challenge. Your question was like, where's that mix come in? and and that in and of itself is a challenge, because some of the most expensive words that have ever been issued on Wall Street are, it's different this time, right? You're like, these are the reasons why it's all different. The internet's going to change absolutely everything. So the internet was going up. It's like, it's totally different this time. That's why, we don't have to price on earnings. We can just price on eyeballs, and we can price on XYZ. And for a couple of years, you could do that. But at some point, it was not different. The internet changed absolutely everything. They were right on the premise, but ultimately the valuations all came back down to some sort of reasonable expectation of making money for the company, right? So when you hear that it's different this time, it's a challenge. So you do have to balance a long-term view of what has tended to work long-term. You mentioned NVIDIA. So NVIDIA on some metrics are super cheap, not super cheap. That's a bad phrase. By the PEG ratio, it's kind of cheap and reasonable. The price to sales, NVIDIA traded at a price to sales of 2 to 3 for the better part of its history, and went to 44 times sales.
Mhm.
Your chip maker trading at 44 times sales. Like, you have to 22x your production of physical chips to, like, I don't even know how you do this with supply chain problem, but they're growing so fast that their growth is really big. So on some metrics, people look at those metrics and say, what are we going to value at? We're going to pick and choose which is cheap and which is not cheap. And at some point it shifts. So you have to have, I think, at the end of the day, just have a long-term view. You have to have a Warren Buffett kind of view. Warren Buffett will say, I don't know what's going to happen in 3 months or 3 years, but in 10 years, if I'm buying a good company that's growing, I'm pretty sure I'm going to make a lot of money, is kind of his thought. When the financial crisis was falling apart and everybody was like, there's blood in the streets, he bought $5 billion worth of Goldman Sachs. He didn't buy it at the low. He bought it 6 months early, but 5 to 10 years later, he looks like a genius, right? 6 months after the purchase, he didn't look so smart. Years after the purchase, he looks incredibly smart, right? So long-term view is the thing, I think.
Yeah, I was on a flight, and this probably happens to you if you ever fly commercial. Someone asks like, "Oh, what do you do?" And you tell them, they're like, "Got any hot stock tips?" And I was sitting next to someone. I go, Chipotle is going through this thing right now with the E. coli, but they have a very loyal brand base, and they have a lot of stores, and they're still opening up stores. That would definitely be one that you could consider. And it was trading at like $400. And then I looked over the next 6 months, it went to like 250. I was like, oh man, that guy probably hates me. Now, now I fast forward and I'm like, Bill Ackman bought it. He took over,
Right.
changed out the CEO. And I was like, I wonder if that guy, now I'm like, I wonder if that guy bought it.
And stay, right? I mean,
Because in the short run, it's scary. You can make a great decision. However, your timing could be off, and it's scary when you watch your dollar investment turn to 70 cents, 65 cents. And then all of a sudden, 5, 6, 7, 8, 9, 10 years later, you're like, oh, it all worked out.
it all worked out. Ackman, he had a couple great first years, and then he had several really, really miserable years, and especially the whole thing with Herbalife and the pharmaceutical company lost 90+% of its valuation. But if Herbalife was his biggest short that he'd ever had, right? And he's going on NBC saying, "Hey, I'm shorting the stock," and he gets in a big fight with Carl,
Icon.
right? And so just watching this all play out, and if I go into a chat room and say I'm shorting a stock, that's like against the law. But he can go on national television and say he's shorting the stock, and here are the reasons, and really, call in his Congress buddies to drag Herbalife into a congressional hearing to really make things look bad. And of course, he ultimately gets out of it. But had he stayed in, he would have won. Right?
Yeah, I was listening to an interview, and he's like, in my mind, I'm still short Herbalife. And he was telling how after the whole debacle happened, Carl Icahn actually called him and goes, "Hey, Bill, good job. Now we can do business together." And Bill Ackman's like, "I'm not doing business with you. Are you crazy?" But apparently that's just how Carl Icahn is. He's like, "Hey, we went through it. We battled. We can do business together. I like you, Bill." And Bill's just like, "No, absolutely not."
Well, did you read the Wolf's? I think it's Wolf's Bite. It was written by. He's the host of CNBC. I can't think of his name right now. He's on all the time. It was about that whole battle between Icahn and Aikman and what was going on. And um, it was a fascinating read about what was happening between the two players. And before that, it was my understanding and my recollection of the book was Icahn was unhappy with what Aikman had done in some previous business dealing. And so he was really kind of looking for a little bit of revenge to
Yeah, I
some
don't know what
extent.
it was, but I remember Bill Ackman saying like they did a deal together and then Icon just never paid him. And then Bill called him and was like, hey, are you going to pay me? He's like, no. He's like, I'm going to have to sue you. He's like, okay, sue me. And then he ended up having to pay him. And then the Herbalife thing came out. Carl Icahn was coming on the news saying, I love the company. I love the stock. And he was buying it just to mess with, just basically just the mess with Ackman.
And he can buy Aikman over multiple times, right? So, and I don't know what your perception is, but my perception is Icon's a lot more likable character than Aikman is, and so Aikman's going on saying it's the worst stock ever, biggest short of my life, and Carl comes on and he's like, I don't have a problem with Bill, I just think he's wrong, and I like it, and it felt like they were playing poker, and Carl beat him like 3 or 4 hands in a row and just wiped him out, right? You just couldn't stay in the game any longer.
Well, that's the thing about investing. Most people never get good at investing because they are like, oh, investing's not for me. I'm just never going to invest, rather than looking at what can you learn from the situation,
Yeah.
such as that's why I hop on social media and you have all these financial influencers saying, invest in Vanguard ETFs because no one ever beats the market. You just want to invest in this. Obviously, no one can beat the market. Not Warren Buffett, no one, blah, blah, blah. Just saying whatever they can to sell a course. And I'm just like, well, if so many people can't beat the market, then why do all these big companies own individual companies? And that's the sort of education people are getting right now versus figuring out what mix works well for them, potentially finding a great company at a good price. Like in 2022, you could have gotten Google at a 15 price to earnings ratio, which for Google and being a technology company is fantastic. And that's why Warren Buffett bought Apple in like 2015, 2016. It went to a 10 PE. Apple had been in business since the 70s. So obviously he waited a long time and they ran up a lot from 2008 to 2016, but then it hit a PE of 10. And Mr. Buffett just like, well, good company, good price. I'm going to put some chips in.
Yeah. Yeah. And now Apple's trading, or it did trade up during post-COVID, traded up because it was kind of the only game in town. If you recall, there's maybe 5 stocks that did well in 2000 during the COVID era, and Apple was one of them. It went up to a PE of 45.
Mm-hmm.
And it had traded at a pretty consistent PE of 15, like 13 to 18 for the 10 years prior to COVID. And it goes up to 45. And Apple's growth rate didn't change. It's only growing at maybe 5-6% on average. So it's not like Apple's a hyper growth company. But to have its PE triple, that's a big thing. So that happened in Microsoft's history too, where its PE went way up, and it was dead money. Microsoft was dead money for a long time. Now, obviously, Microsoft's doing great in the AI world as well, but I think again, taking a long-term view, Apple is a genius at making money and printing money, but to have it trade at a PE 3 times what it was, I think that you should like think about things like that. When you have that 2 standard deviation move, you probably need to reconsider. And Buffett considers it on the downside. When it was down a good standard deviation or so, now's the time to get in. When it goes trades up a standard or 2 standard deviations, maybe the long-term prospects aren't so awesome at that point.
Yeah, I remember when I first started investing, I would be watching a company I owned and earnings would come out and it would go down a lot. And I'd get so excited. I'd be like, yes, I can buy more. And I always remind myself of like that moment of like, you actually want the good companies that go down. It could be painful. However, if you've set yourself up correctly
Yep.
so that you're like, hey, listen, I don't have cash right now. But if you have in your mind, like, hey, if this goes down, I'm going to take capital from here and put it here and have that sort of strategy in the back of your mind, you're always going to be ahead of the curve. Based on your experience, what you're doing for your clients, for people who are just taking a mutual fund, exchange traded fund approach, obviously they can still be successful. They can still make a reasonable rate of return over time. How is that in your thoughts and opinion, like that narrow mindset of just focusing on those things, work against someone over the long haul?
Well, I mean, quite honestly, if you're not going to do the work and you're just, even if you're going to do the work, so the math says that the research says that it's very true, 60 to 80% of all fund managers underperform the index year in and year out. So I always like to throw out the kind of this, I don't know, thought experiment, but this is actually real. There's 10,000 mutual funds out there. So if, in the past, there was a scam where you could send out to 100 people, buy, like 50 people, you'd say buy Apple stock, and 50 people, you'd say sell Apple stock. And then whatever happened to Apple in the next week, then you go to the next, those 50 that you're right, and say 25, you say buy NVIDIA, and 25 sell NVIDIA. And then eventually you're going to have 3 or 4 of them. As you do 3 or 4 or 5 weeks in a row, you're going to have a handful of people who are like, I was right 5, 6, 7 times in a row. So you gotta trust me, right? So if you do this with mutual fund managers, say in any given year, half of them are going to outperform and half will underperform. And then in the next year, let's say you went from 10,000 to now 5,000 outperformed. The next year, you're going to have 2,500 that have outperformed 2 years in a row, and then 1,250 that have outperformed 3. So after 10 years, you end up with 10 fund managers that should have outperformed from just dumb luck, just silly dumb luck. And when you look at the history, that number is usually 0. Usually have none. So the math would suggest that you should always have at least 10, and we never have any. So no matter how we slice it up, usually the fund managers tend to underperform. So your question is, if you just have somebody that's just buying the index fund, they're probably going to do okay. But because we're a math house, I do believe that there are strategies that can help outperform over time. And we have shown it. There are hedge funds that have demonstrated it. There are other places you can demonstrate it. You can have simple strategies like a buy right strategy that tends to outperform and reduces volatility. You could buy structured notes that have leveraged upside and downside protection that over time should outperform. So we're in a weird spot, but just buying the equally weighted S&P 500 has almost always outperformed in any 10-year window, except for this most recent 10-year window, but has almost always outperformed. So there's a lot of strategies where you cannot beat the index. It's just a matter of, if you're not going to do any of the work or the research or find those areas, then you are pretty well positioned to just buy your index and then forget about it and just worry about the rest of your life.
Well, you're a CFA and you know the test, and you've passed all 3 levels, right?
On the first try.
First try. Yeah. I took part 1. I was like, this isn't for me. It's just not my way of thinking. It's more in the box. I'm more outside the box. So it takes a special person to pass that exam. And I'm not one of those special people. That's okay though. Yeah. And a lot of those CFAs become mutual fund managers. However, nothing on the test that I saw teaches you really about portfolio strategies until part 3? Or on any of it, because I was like reading it, I was like, I want to learn about investing. I was like, this is all accounting stuff.
Part two is the most challenging one. That's usually what trips most people up, where they have to take it repeated times, 2, 3, 4 times in a row. You have to wait a year. So you fail it, and you got to wait a year before you retake the part 2 again. Pass rates are around 40% on part 1, around 40% on part 2, maybe 50% on part 3. So pretty low. But I think that the portfolio management, you get into some of that with part 3. It's more about the positioning, like your portfolio position. Who are you as an investor? What's the best investment strategy for you? What are your required returns to your goals? What are your desired returns? Like I might be desiring 10% return a year, but I only need 5 or 4. So if I only need 4, do I need to take on the risk that gives me 10? So because every 7 to 10 years, I'll get my portfolio cut in half. Now, maybe long term, I'll be all right, but maybe that kicks me out of the game or really changes my lifestyle at some point. So do I want to manage to a desired or required rate of return? And what if it's upside down? What if my required rate of return is 10 and my desired is only 4? Like I'm just super conservative and I don't have the risk tolerance to take on or get 8, 9, 10%. That's also another big discussion. So part 3 was a lot about that. It's a lot about how do you manage those differences and distinctions between your portfolios, and how do you get to the goals?
Yeah. I mean, most mutual funds have hundreds of positions. And if you look at all the best managers, they don't have hundreds of positions. They typically have like 10 to 20 at the most, maybe a little more, depending
Well,
on how concentrated they are.
Ackman's famous for being concentrated, right? You'll have like 4 to 6, somewhere in that range.
Yeah, right now I think he has like 8 or 9.
Okay.
I know he just sold Lowe's. But with these mutual funds taking the CFA, and obviously not all CFAs are created equal when it comes to investment returns and everything, just like, there's better doctors in some areas than others, and there's better attorneys and there's better accountants. Obviously when you get into the business world, not everyone has an equal playing field, but not everyone is the same level player. So what have you done, even though you've taken this test, you have your background in engineering, to help separate yourself from your peers that have CFA behind their name?
Well, first of all, I'd say most of my clients could care less whether I have a CFA or not. Like they have no idea what it is. It almost never comes up in conversation ever. Like they've even probably heard of a CFP. Some of them have heard of CFP because it's a little bit more publicized in the retail area. And as you said, CFAs are generally more institutional. They run in more institutional money. So, it's almost a non-issue. But what we do, I think, is different than most advisors. Is we do take our management and our diversification and our portfolio, modern portfolio theory 101 to, I won't say an extreme, but we diversify across 20 plus asset classes, right? So most portfolios that we see, if I see a portfolio that comes to me, say, hey, take a look at it, it's almost always, especially recently when nobody wanted bonds because they're not paying any rate of return at all. And if interest rates go up, bonds just go down mathematically. That's not speculation, it's bond math. So there's no reason to own bonds. You're not getting paid, and the only risk is down. So a lot of portfolio, like individual investors, just didn't want to have any bonds at all. So their portfolio was all stocks and then concentrated in tech stocks often. So no diversity, no international, no real estate, no commodities, no very small caps. If they had an allocation, it was almost meaningless allocation to the portfolio. So what we lead with is, yes, you need to have these, but at this point in history right now, we're at multiples that are around the .com multiples, not quite as high as what they were, around COVID multiples. Again, not quite as high as what they were, but a standard deviation above average multiples. And from these multiples, historically, when you look at the data long term, we have never had good forward 5-year returns. Never. The best we've ever seen is about an average rate of return of about 5 or 6%. That's the best. Now, could we beat that? Yes, of course, that could happen. Have we ever beaten that in the history of our stock market? No. So as a math guy, I want to bet on history and that long-term view stepping in. Now, in any given year, you've seen awesome returns or really horrible returns. So the next 12 months, and there's almost no correlation between the multiple and the annual return, like a 12-month window. It's almost zero is the correlation. But a long-term correlation between the current multiple and where we're going to end up is actually pretty reasonably strong. So we could have in the next 12 months 30% upside. I have no idea. But a long-term rate of return is going to be kind of flattish. That's what if you run an expected value or do a regression, you're going to be close to zero from where we're at over the next 5 years. So as a CFA, to ask you, where am I going to get these returns? If I have a long-term view, I either have to tactically be in and out of the market and capture that 30% upside and then get out for that 30% downside that we're going to sure see, or I have to find them in other asset classes. So private equity, I got to find them in structured notes. I got to find them in sectors that should outperform over time that are going to be different than just the general market, right? Maybe sectors that aren't so built up like technology and have such high multiples, maybe we're going to have to move in, because there's always a shift back and forth between growth and value. It always happens. They say it's different this time. It's never different. Sometimes it just takes longer and people just haven't been in the marketplace for 5 or 6 years, but it's going to shift at some point. So it's not different this time. It's just a matter of when is it going to happen and how do we get those returns. So to answer your question from the CFA standpoint, I'm trying to think of the areas of the market that are poised to be outperforming, that have been left behind. One of those areas might be international. So the United States usually trades at about a 15% premium to international stocks. And right now it's trading at roughly a 30 to 35% premium. So I don't know, at some point, international is going to at least regress back to that mean, which would mean a 15% outperformance. I don't know what, maybe it's tomorrow, maybe it's not for 3 years from now. I don't know. But if we're going to take a long-term view, maybe I'm leaning a little heavier on international stocks right now than I would current. But what does work short-term is momentum. So momentum right now, short-term, tends to be up. Not today, but longer. The momentum is positive. And so you've got to factor all these things in. These short-term indicators are momentum, relative strength. As you mentioned, algorithms trade about 70% of the market. So if the algos are in and they are saying one thing, you can't ignore that. And if they start looking at the patterns and the technicals of the stock market and start selling off, you've got to respect that trading. And that's what happened in 2022, I think. The algorithm said, nope, we're out. You could see the clear defined path, like higher highs, higher lows, and then it broke down, broke out of a channel. And you could just it's a case study of some technicals right there. We actually stepped out. We're out of 75% of our equities in February of 2022 because of the algorithmic trading signals. So we just stepped out. So where do we add our value? We try to add our value in alternative asset classes, looking at asset classes that have been left behind, trying to be more tactical, those kind of things.
Love it, Stuart. On that note, we'll see everyone next time. Bye, everyone.